Good morning, everybody. It is Friday, May 14th, 2021. This is Kirk Spano, Investing 2020s, and the websites are fundamentaltrends.com. And we also write Margin of Safety Investing over at Seeking Alpha. So on Wednesday, I went to the doctor. I've had some impacted ear problems since January. There was a weird weather back then. You may remember me talking about it. And just had a huge buildup of wax, couldn't get it all out. Probably pushed it in with a Q-tip. Don't do that. And it's mostly out. We were able to get the right ear 100% clear. But the left ear was troublesome. So I've been on pain medication for the last 2 days because he went digging in there and wasn't able to get all the wax out, but irritated the heck out of my eardrum. So I've been taking a painkiller since Wednesday afternoon and not getting a lot of my work done. So I apologize for that. I feel better at the moment. Got up a couple hours ago to start putting together something for this presentation today, and the internet was out. It just came back on at 10:59 Eastern, so 9:59 my time. I was just planning to do a Q&A and to buzz through some of the things that you can see on TradingView, which I subscribe to. And then also I wanted to show you the tree rings report for last week. So the tree rings report talked a lot about looming inflation. And I'm on the other side of that. I think that this is very, very temporary. I think it's a reflation, just like we got after the Great Recession. And that the predominant trend is deflationary. That's tied to demographics. That's the article that I wrote last week on Seeking Alpha and also published to Fundamental Trends. There you go, deflation versus inflation. So this is under the free library card content at Fundamental Trends. So if you don't have any membership at all here and you just like to try out, I do have quite a bit of the macro and some other things here under the free content. So go ahead and get a free library card. Pretty easy to do. Just hit subscribe. And if you just want to try us free, go ahead and try us free. All right. So tree rings. Again, I subscribe to this. And every now and then I put a PDF report on the website as kind of a trial for you. I tell you what, for $200 a year, this is the easiest to most read macro that's out there. I don't always agree with the opinions, but the data and the ideas are definitely something to consider. I come at everything from the standpoint more of a Keynesian economist and a pragmatist on geopolitics. These guys come at it as Austrian-style economists, which, again, I think is probably right for most of the world, but not for the United States. And the reasons being is that the United States is, in fact, a special place, and that we can and should stimulate the economy when we can, globally. Because if not us, then who? Some president back in the 60s said that. And it's a long argument, but essentially it emanates from the idea of American exceptionalism. And I do think that we are exceptional. I think that we have the best hunk of real estate on the planet. We have virtually everything that we need. We have friendly oceans to two sides and friendly neighbors to the other two sides. And in fact, when you consider that the measure of your country is the people who want to move into it, then I think it's pretty clear that we're the place on earth that you want to be. And while we complain sometimes about the southern border being not as structural as it should be, and I don't mean that from the wall standpoint, I mean that from the, we should be giving out a lot of work visas and other types of entry, asylum, people who want to be here. And in fact, what we've noticed, and we talked about in the article last Friday, Thursday and Friday, is that the United States has a demographics problem. getting old quickly. The millennials are helping offset that. We took a look at all those charts. Take a look at them again if you like. But the reality is that we need more young people in this country. Birth rate dropped to the lowest since 1979 during the pandemic. There's just a Los Angeles Times article that detailed just how severe it was. I would have thought, much like a snowstorm, there have been a lot of babies 9 months later. But what really happened is that a lot of people felt so unsure of themselves financially, they put off making babies. So having a smart immigration policy, particularly along our southern border, where we vetted people and then figured out how exactly to let them in, whether it was asylum, work visa, something else. The dreamers, I would snap my fingers and make them all citizens. It would be good for America to have a lot of young blood. So there's probably a smart way to do that. And I know they're talking about it on Capitol Hill, but it does seem that politics is getting in the way. So who knows which way that'll go. So when you take a look at the charts, let's talk about inflation. There we go. Who should Warren Buffett and Sam Zell believe on inflation? Janet Yellen and the Fed, or their lying eyes? Well, I would say Janet Yellen and the Fed. Because the reality, as Krugman points out, that we never really did pay back World War II debt. The debt we're taking on now is probably more deflationary than inflationary. Why is that? Pretty simple answer. Same answer that it's been for decades. Was a little bit of crowding out. You ever took economics beyond levels 101 and 102, got up into those 300 level classes? What you learned, and you could see by example over and over again, is that when a government runs a gigantic debt, it is short-term stimulative, but long-term depressive. So the United States, like many other countries in the world, have this huge problem of debt where while we're printing, while we're taking on debt, while we're doing projects, it's stimulative. And the stimulation goes in different directions. If it's monetary policy, like with quantitative easing, we've learned that it flows into assets. If it's fiscal stimulus, which we really haven't done enough of since the Great Recession, probably for a decade before that, then it flows into paychecks. But we'd much rather have it in paychecks because that goes to 80% of the population versus the monetary stimulus, which really goes to about 1% of the population with some schnibbles available for the rest of us. We know that the monetary benefit through QE has gone somewhere between 70 and 85% to the 1% richest people because they are the biggest investors. Fiscal stimulus, on the other hand, which included stimulus checks that people got, which is going to include likely millions of jobs in clean energy and infrastructure and labor level jobs, as well as R&D. So your PhD brainiacs can get a taste as well. I believe that's one of the popular phrases right now, get a taste. Wet your beak? Yes, wet your beak. So when we consider inflation versus deflation, we need to get ourselves out of the narratives of the traders. I've talked about this over and over again, is if you're not a really good trader, right, you don't have the time to play with algorithms, and all you really have is a cursory relationship with charts, you should be what's called a position trader. You shouldn't be a swing trader, and you shouldn't try to be a day trader. Position trader, which is primarily what I am, I'll throw some swing trades in there here and there, but a position trader tries to buy near the bottom of a cycle and then hold to the top, give or take. So if you consider the S&P 500, take a 5-year chart, and say, okay, where are we? Well, this was clearly the start of one cycle, 2015-16, after that 18 months of consolidation, and it ran to here. About October of 2018, met with a big correction. But what do we see here 2018? So we had the volatility event at the start of the year, which really had to do with the VIX imploding. The S&P 500 was overbought. We got a correction. It was 9%. This represented a 9% correction here. Went up, almost got overbought again. Then we got a 19% correction. Started to get towards overbought, corrected, came back, and then they bailed it out for the repo market after it started to fall again. So the bailout of the repo market from September 2019 to February of 2020 drove the market up, overbought. I was covering this at the start of the year, saying, hey, stock market's overbought on a weekly basis, 52 periods in a year. It's going to get sold off. And it started to get sold off even before the pandemic. That's January 20th. Got a little bit of a rally, that retirement plan money that goes in at the start of every year. Then the pandemic hit, fell off cliff. I would argue it was going to correct from here anyway. It may not have gotten all the way down here. I would have gotten in here somewhere. Would have had another 9 or 19% correction. Now here we are, massive stimulus driven rally. Got back to overbought last week, which I showed in this article right there. You know, that's a chart from May 6th. It turned over, certainly did. So now the question becomes, is we've had this little breather. So let's change this to a daily chart. And look, the daily chart fell off. Now it's rebounding up. What should we expect? Either it runs back up to around here, or even up here, right? It's gonna, somewhere between here and here, then it's gonna turn back down. My guess, based on the market action today, is that we sell off into the close, or we get massive panic buying. And I don't really know if the public is ready for massive panic buying just yet, but maybe. Well, one way or the other, I'd either see an acceleration into the close or a complete reversal. I don't think we should expect a lot of ho-hum, which means we'll probably get ho-hum. Regardless, when it gets back to overbought on the daily, could do that for 4 or 5 days, up to 14, but usually 4 or 5. You know, sometimes it takes a few weeks to pull this back up. Usually it takes 1 or 2 at this point. When this gets overbought again, we're likely to see a resumption of the same fears that the narrative played out last week. But really, and we've talked about TLT, the long-term bond, it's what we should be watching. What does the long-term bond tell us? I told you, we may want to be buying the long-term bond at some point soon. Why? Because when the long-term bond gets really oversold, that's people thinking there's going to be inflation and the interest rates have to go up. Janet Yellen talked about how rates might have to go up at some point. We'll see. I think that was her putting a prick into the bubble because she knows that deflation is the big boogeyman here. Neil Kashkari, who's a Republican, just on all the morning talk shows last Sunday talking about that. So if you ever want to read something and you want it to be from the contrary point of view of the administration, and so go read Neil Kashkari, Minnesota Fed president. He talked about all the same things I talk about. Not a partisan issue. Can't argue that demographics are a partisan issue. It just is. One of the few times where you can say it is what it is, and it actually means something, because I think that's a very overused phrase. So one of the things I'm going to do tomorrow morning when I do the review, so I'm going to include a copy of the Tree Rings report from last week. His new one is up tomorrow. I'm not going to include that because it's new, but I will include the code to get this. And if you are interested in macro and you have an open mind, because I'm going to say things in here are wrong from time to time, but it is just a fantastic summary. Great data. way to keep you balanced and anchored, and making you look at things from different perspectives. Get this out to you. One of the perspectives that we should have is what's going on with inflation. Neat feature of trading view, if you don't have it, is you actually have just all sorts of great ideas that they put out here for you to study. So if nothing else, I've got the link for you for this too. Get a free membership. You don't have to pay for one, but they have a great learning section. You can learn technical analysis, all sorts of examples. They have ideas. Now, granted, a lot of these ideas are people pitching an idea because they want you on their side of the trade. But the educational stuff, generally the editor's picks, pretty darn good. I've been in here a few times. So let's take a look at inflation. Do we really have long-term inflation? No. As I've said, coming off those low levels from last year, super low levels, you're going to get a spike. And this is going to happen because, one, law of small numbers, but two, you've had all sorts of supply chains goofed up. Semiconductor supply chain is goofed up. A lot of metals supply chains are goofed up. We're at the very, very beginning of the EV age, but it's moving rapidly. You have a hyper manipulated oil market. There's not really any other way to describe the oil market. So we're going to see prices higher. Interestingly, I think lumber just spiked. I think it just peaked. I don't think lumber is going to go any higher. And here's why. President Biden's going to rescind the tariffs on Canadian lumber. There's a lot of boards sitting up there right now. So once we start getting a lot more Canadian lumber into the country, which I think is going to happen imminently, like within days or weeks, price of lumber will come down. That'll be pretty deflationary, or disinflationary is actually the proper term for that. Well, everybody's pointing to lumber. Oh my God, it's costing me an extra $13,000 to build my house because the wood is expensive. And they're saying that about $400,000 and $500,000 houses. Sometimes you just focus on the wrong things. Here's the question to ask. Why is a new house with 2,500 to 3,500 square feet, and that's a fairly decent sized house, why is that costing $500,000 to begin with? It's not the commodity level pricing. That we really like our Kohler sinks. We really like our granite countertops. We really like all the little extras that we put into a house. We really like the stainless steel kitchen set. Right, go right down the list. There's nothing wrong with that. You can afford it. So the interesting thing to me when it comes to the housing and the real estate market is that new homes for a hot minute here are cheaper than buying on the resale market. That's been going on for a couple of months now. So even with the more expensive lumber, it's still cheaper to build new than buy resale in almost every market in America. So what would you think as the price of lumber comes down would be the logical extension of that? Be a lot of new houses getting built next couple of years. So there's a lot of Canadian lumber that needs to get nailed into something. So this spike in lumber was artificial. I mean, yes, there's a lot of people who did home projects during the pandemic, but the Trump administration had cut off the supply of lumber to protect a couple of their friends, American lumber producers. Neat feature here at Trading View is they have this little arrow here, so you can see what's happened since they printed the chart. Now, it didn't help with this one because it was yesterday. But if you go and grab an idea that's a month old, you can press that little button. It'll show you what their projection was and then what actually happened. It really is a fantastic tool. One of the places I want to get invested is in everybody that has something to do with home building. So we bought Pulte a long time ago, took a look at some of the other ones, and they've all taken off. Take a look at home builders ETF. That is a heck of a run, isn't it? Let's parse this out. The home builders already spiked, right? Overbought on the weekly, which means you expect a 10 to 20% correction at least. Money flow is lower than relative strength index, so that means that the volume doesn't support the move because this is price weighted. So when this is higher than RSI, that means it's a really strong move. When it's lower than RSI, the opposite. Then you flip that at the bottom. Depends on the direction you're moving. Taking money flow, which we like, shows that money flow is really pretty much peaked out here last week. Doesn't mean that they can't have one more fit to the upside. But understand, if you're betting on any chart like this to go up one more level, you're rolling the dice. You're hoping you don't crap out because that's the best odds you're going to get. 50-50. Not a lot of putting the odds on your side here. So somewhere between here and here looks pretty normal-ish as a correction. Mid-60s to mid-50s. What if something bad happens to the economy? I don't expect that. But as we talked about, a lot of these pandemic low prices, although they got oversold, that was only roughly fair value at the time. I think fair value has come up because these companies are going to start making even more money. So middle 60s, middle 50s. I think fair value is probably middle 40s. So if we did get a really big correction down to the middle 40s, you have to be really interested in these stocks. This is how you prepare. Go back to TLT, got oversold and bounced back up. I'd anticipated getting oversold again because people are going to keep seeing inflation because it's what they want to see. It's part of the whole Bitcoin meme. Had a great conversation with Dr. Sean Stein Smith at Lehman College this week. Did a recording. Have that up next week. It's getting produced right now, getting a couple slides put in. He is an expert on cryptocurrency. He writes for Forbes. I'll get you his links, but Sean Stein Smith, he's the reason that I resubscribed to Forbes. I will tell you that I think Forbes has become harder to use because, like MarketWatch, they got rid of a lot of their experts. And that goes towards the whole movement here in the last 10 years, I'd say, but really very recently, especially, of not wanting to listen to experts. And at some point, not listening to people who have been there and done that can be real bad for some people. As we shift from monetary policy to fiscal policy, the stock market's going to become unstable, even more so. It's going to be a tough year. You're going to have to pick your spots. Wednesday, I believe it was, I put out the options that you could be selling, the puts. Had you sold them on Wednesday, you're already up pretty darn good. We talked about them in the Tuesday webinar. Selling puts on a month-to-month basis right now is probably one of the best strategies that you can have. Sell puts on things that are oversold or close to oversold on the weekly chart. And you're going to a lot of times get one of these little rebounds that coincides with the 3 to 7 weeks that you have on that put, which is going to be pretty typical range. And from time to time, you'll get something put to you that you really like at a discount to today's price. Pretty nice consolation prize. In fact, when I sell cash secured puts, I really would like to get 2/3 of them put to me because I really want those stocks. So the limit orders that I promised for Wednesday, which I just couldn't do because it feels like I had somebody punch in the side of my brain with that ear procedure, I'll get done this weekend. I'm going to cover about a dozen dividend stocks and about probably 20 growth stocks that are at prices that I think are pretty close to what we should be looking for. They weren't part of the memes that just went to the moon. And they're not part of the typical value rotation, which we're benefiting from with Kinder Morgan and AT&T and Lumen Technologies all kicking us out 6 and 7% dividends and up probably 10% in price this year. So ahead of the market with boring old AT&T and the old CenturyLink and Kinder Morgan, some hated stuff eating the market. One of the other places that we have to refocus, and because it's not in the news thing right now, are the SPACs. We've got 200 zombies, give or take, on the S&P 500, companies that have huge debt and aren't really profitable, don't have real good long-term outlooks. Some of these SPACs coming to market where they've already announced the deal, right? There's two classes of SPAC, the ones that are just speculative, piles of money, and the ones that have announced the deal. Some of these deals are really good. Doesn't mean they can't trade around 6, 7, 8 for a little while when the market just doesn't know what to make of it, and before the institutions start to take positions. Some of these SPACs are going to be pretty good. Soaring Eagle SPAC is interesting. People have asked about that. I think that'll be a good deal. I'm not expanding my holdings, but I'm keeping the units. So I'll end up with shares and warrants here in the not too distant future. When it gets a big rally, I'll sell the warrants, hold on to the stock. Then I'll decide what I want to do with the stock. Remember, warrants are extra long-term leaps, basically, and the calendar starts to work against you. So anything that has an expiration date, right, you eat that one first. Like something in your refrigerator. You got the milk that expires next week and the milk that expires in a few days. Have a couple glasses out of the one that expires in a few days before you get into the one that expires next week. Keep the calendar on your side. So what type of bigger questions do you guys have out there? I will tell you that the conversation that I had about Bitcoin and crypto projects was pretty interesting. Now everybody and their brother out there is talking about should they be shorting this stuff. You know, here's the Satoshi. I didn't even know this existed. This is 1/100 millionth of a Bitcoin. As I've told you, I think the Bitcoin chart could look a lot like this at some point. One of the things we brought up, I want to show it to you here, because I put it in our chat, is the power of ETFs on a market. This is gold. And when money started flowing out of the gold ETFs, price of gold stagnated, went down a little bit, had that little small correction that lasted about 6 months. Meanwhile, the demand for gold for actual use went up. So the ETFs were the marginal money. The same thing is going to happen with Bitcoin if they start doing Bitcoin ETFs. We've got Grayscale, which is a trust, basically a closed-end fund, trades at a discount, the net asset value. As you'll hear in the interview, I think that it's smart. I think it's actually good that you don't have an exact tracker or near exact tracker for Bitcoin. And if they start doing futures-based Bitcoin ETFs like USO and UNG for oil and gas, they track futures, they don't actually hold the oil and the gas. I think you're going to see a spike in Bitcoin and then it almost get wiped out into oblivion. If they have a physical ETF, one that actually has to hold the Bitcoin, they're going to also end up being the bag holders. Because as we've talked about, 2% of all the Bitcoin accounts hold over 80% of all the Bitcoin. So you'd have those giant hodlers of Bitcoin selling into the ETF, basically unloading their Bitcoin onto the public, under the mistaken impression that it's going to be used more and more in transactions. If you're not aware of the definition of money, it's whether or not it is a store of value, a unit of account, and a medium of exchange. It has to be all three things. Like gold isn't money. It's not all three things. We don't use it as a medium of exchange, right? You don't pay me in gold. If you'd like to, we'll arrange it. And Bitcoin's going to be the same way. It's not going to be a medium of exchange in most places. Now, if you load spyware onto a natural gas and fuels pipeline, you may be able to extract $5 million worth of Bitcoin as a ransom. Or if there's something illegal out there, like certain online gambling, which actually isn't illegal. It's just illegal for the banks to transact with them. You might use Bitcoin. What if it stays that way? What if the financial institutions and banks and other intermediaries have a law thrown at them that says, hey, it's nice that you set up for cryptocurrency, but you can't use them unless it's a crypto dollar or a stable coin attached to the crypto dollar. Well, not much point in having a stable coin attached to a crypto dollar if there is a crypto dollar, which there will be. They just launched 5 test projects. And there's some pretty strong arguments for cryptocurrency. The main one that I think carries the most geopolitical weight is that in a lot of countries where you have authoritarians and thieves running the joint, commies, they can use their currency to oppress their own people. One of the beauties of Bitcoin is that it had the promise of being more egalitarian. We can do that with a crypto dollar, but there has to be a mechanism to prevent it from deteriorating like the dollar has over time. And it doesn't have to be a very strong mechanism, because the reality is that the dollar has remained very strong despite our deficit spending the last 40 years. Chops around in a range. I've showed you that range a number of times. If we introduce the crypto dollar and have some limit on the number of crypto dollars that are in the vault, we introduce 300 trillion crypto dollars to the world. We say in the first year, they're priced at $1. And after a year, we're going to measure for inflation. We'll make a 1 or 2% adjustment. If they do something like that, then they also adjust for countries that want to peg to the dollar at that point. You have fortified the value of the dollar by having an ultimate limit on them. It can only increase with inflation or as countries peg to it. So if you create 300 trillion crypto dollars, which I've looked at 4 or 5 different numbers that it could be, has to do with what's priced in dollars now. And say a country like the Bahamas says, hey, you really just like to use dollars here in the Bahamas. And you say, okay, that's a whatever size economy it is, say 100 billion, I don't really know. We're going to add 100 billion crypto dollars to the pile. So long as the Federal Reserve can't click at will, there's a formula, set of rules that governs the number of crypto dollars that get added to the system, just like mining Bitcoin, right? There's a certain number of Bitcoin that get added to the system based on the mining, and it gets halved every so often. You can come up with something smart to preserve the strength of the dollar on a balance sheet, the store of value function, unit of count, you're pricing it at $1. Maybe next year it costs $1 or $2. Pretty interesting, right? So that dollar that you bought in year 1 for $1, now that crypto dollar is worth $1 or $2 in year 2. You got appreciation versus depreciation. Do you think the institutions of the world wouldn't love that? And the more countries that use the crypto dollar for their transactions, even if they don't peg to it, it's more money going through the US financial system. And who's going to keep that ledger? It's going to be all the SWIFT bank institutions and the American banking system and whoever else that we approve. All those little fees for transacting Bitcoin on the ledger now go back into the financial system. It's pretty easy to engineer this, actually. The thing that I fear is we have knuckleheads that make the ultimate decisions. We'll see. But there's a pretty easy compromise between the Keynesians and the Austrians, the deficit hawks and the expansionists. Pretty reasonable sets of agreements they could come up on if they have the soul to do it. They play politics with it, it can be horrible. So we have to watch what exactly decisions get made in the next year or two. Because I would guess that the crypto dollar is live and active sometime late next year, second half of next year. All right, types of questions you have that are more macro based, more ETF based, not taking stocks questions today. That's for Mondays. Do you think it likely that the economy will enter into deflation sooner rather than later? Is it inevitable that the economy eventually enters into deflation? The economy has been in deflation for over a decade. I think that's what people have a hard time wrapping their head around. I had a chart in here that spoke to that. We've been fighting deflation since 2008. And we've been fighting it with cyclical policies. This is why I keep pointing out the secular trend. Secular trend is up here, right? The world's getting older, and it's almost everywhere. Until these curves level off, which is middle of the century, the big fight is against deflation. Now, if we rebuild the world, I think we're going to be okay here. But you have to separate the economy from the stock market sometimes, because right now, the stock market is priced in basically all the good things for the next, give or take, a decade. So that means to get your investments close to fair value, you have to cherry pick. You have to find the ones that are still at near fair value. Every now and then you get something undervalued so that you have some margin of safety. Because if you chronically buy things that are overvalued, eventually that big correction comes. And that really good feel-good gain of 100% over, say, 2 years or 3 years completely disappears in a matter of months, maybe even more. It might go below where you started. So I don't usually advocate using trailing stops, but if you're not writing covered calls and you're not trimming, you should be using trailing stops on anything that's up for you, especially the things that are up in line or ahead of the market. I generally advocate a trailing stop somewhere between, either 7 or 12% are the two numbers I use. Because 3, 4, 5% corrections are normal. And you have to know the beta of your particular stock, so you can pump it all the way out to 12% if you want, if there's something that you really want to hold on to and you don't care if it goes up or down 10%. But deflation is the boogeyman. And the stimulus package that Biden is putting together, he started pretty high. I think he actually started at the right number, but he thought it was high just because his perception is what he's already seen. He's not an economist. He listens to people, but he doesn't really have the ability to do the type of research I do. I mean, I don't think he's as good of an economist as me, but he's got people better than me that he talks to. And the reality is we ought to drop even more money into the economy on the fiscal side than what they're talking about. They basically should replace all the QE money with fiscal money. I would like to see them get completely rid of QE quickly and then drop a few extra $1 trillion into building stuff. That would be good for the world. Because then you can rebuild everything in a sustainable, smart way. Good things would happen. Now, we live in the world where we get what we get, and we have to pay attention. Now, do I see a deflationary spiral? No. Well, there's just no way. We'd print $20 trillion if we had to. But then you get these hyper spikes in certain assets. I don't think that's the way it's going to go down. Right now, what they're talking about is roughly the right things to do. Somebody says, how has deflation since 2000 affected me personally? Prices I pay have gone up since 2008. Not adjusted for your income, probably, because you're a pretty good earner. Asset prices are where most of the inflation has gone. We really don't pay much more for food. We just started paying more for food. It has to do with supply chain. There's more than enough food on the planet. We're just dicks about how we distribute it. Farming has become so efficient that it doesn't matter that we're losing 3, 4, 5% of the farmland every year. And we can grow vertically if we really want to. You've seen those projects, seen greenhouse growing. Not hard to do now that we know how to do it. Got a guy in Milwaukee, Will something, got a presidential award for doing it. Hydroponics. Almost nothing that is seriously in shortage. Got more oil than we're ever going to use, more natural gas than we're ever going to use. So, we'll see. I would, my biggest argument would be that the monetary policy is very non-egalitarian, and that's why people grab onto Bitcoin. It's why crypto dollars coming. They're going to pull the dollar into the crypto age, and we'll just see how they do it. It'll either be really good or really bad for Bitcoin. If they do it wrong, it'll be really good for Bitcoin. If they do it right, it'll be really bad for Bitcoin. But you have to separate out inflationary policy versus deflation. Just because the inflationary policy has been more than what the deflation has been, right? You need to separate those two things out. I showed you this chart before that I built. 18 trillion of debt since the financial crisis, and it's higher now. This is a 6-month-old chart, but only $7 trillion of growth. That's the definition of deflation. So we've basically had $11 trillion of deflation. We need to get this line back over here somewhere. We need these lines to come together, and it's going to take basically a decade for it to happen. And that's not going to be great for the stock market all the time. As the monetary stimulus goes away, you better be very selective about how you're investing your money, because the liquidity-driven prices go away. Remember what I said last week, or what I said in the stock show? The new thing is going to be profitability. And while we can, those technology stocks are the place that we want to try to get on corrections, because technology is still king. Places where you can get an asset-light model where they can add revenues and profits without a lot of big inputs, right? They can maintain their margins and expand their margins even. It's where you want to be. So all the folks that want to get into capital-intensive businesses, you better be really careful, because the price of money will probably drift up. Won't be as easy money situation. People want to talk about how inflation is bad for tech prices. Here, I'd offer this narrative. The narrative that inflation is bad for tech companies and that tech companies should come down in price is a way to get you the hell out of your tech companies so that somebody else can buy them from you cheaper. They're bullshitting you. We're not going to get long-term inflation. We're not going to get hyperinflation. I know it's a cool, sexy, ignorant thing to say, but you want asset-light models with recurring, growing revenues. That's what you want in your portfolio. Anything that requires a lot of inputs, anything that has a lot of competition, you gotta be careful with. Yeah, there's a handful of picks and shovels investments out there, not many. Rare earth metals are where I focused on, that along with the gold miners. Because the gold miners also do copper, which they never get priced for, and suddenly that's all the extra profit on their balance sheet. We're not having much prepared today. I think we did pretty good. We're not going to have higher spending till the middle of the decade on aggregate. And it has to do with demographics, population getting older. In the United States, people want to come. People want to come. We should let them in, because then this will be higher. Anybody who's against immigration because they took our jobs, right? We're a South Park fan. They took our jobs. Bullshit. You're seeing right now there's a shortage of people who will work for $15 an hour. Frankly, there's just a shortage of people anyway. Why would you go work at some guy's company or somebody's company for $15 an hour when you could do some sort of a side hustle yourself? Work your own hours and get more. I know dozens of contractors who aren't working for a big company anymore, and they just find weekend jobs to do. And they tell people, yeah, I can come by Thursday night. I have it done by Sunday. Go take your weekend vacation somewhere. And one guy that builds houses, he can't get people to work for $50, $60 an hour. Why? They can go do their own thing, get the same money on their own schedule, and work fewer hours to do it, to get it. Not everybody's trying to get rich. Some people just want to make enough money for a car, a house, and to go hunting or fishing or play golf. Not everybody wants to work 45, 50 hours a week. I don't blame them, especially anything that's physical in nature. I used to be a big-time underwriter of life insurance. I wrote a lot. I think I wrote the most life insurance in Milwaukee a couple times. I had a couple of big groups. I know I was one of the top guys. Might not have been top, but I was close. And I saw people who were laborers and iron workers and teamsters and everything else not get the life insurance they wanted because the insurance companies knew they were going to die sooner. Hard physical labor kills you. Shaves years off your life expectancy the same way the smoking does, really. So I wouldn't expect there to be a big pickup in the people who want to do the jobs that you don't want to do. We need robots for that. But what we do need is more people to help take care of us as we get older. And it'd be nice if the restaurants came back full force. A lot of things that we want in our lives. But as we're the 1 in 5, right? We're the 1 in 5 that makes money in investments. We can't complain when the 4 out of 5 doesn't want to do something we don't want to do. So there's balances that we have to find. I think we should let somewhere between 10 and 20 million people into the country over the rest of this decade. At least maybe 30 million. Start with the dreamers. Start with the people who are leaving horrible conditions in Central America. They really want to be here. They're not terrorists. And they would do some of those jobs in the short run until they reach the middle class. Other people don't want to do. It's the way it's always been. Irish came over here, they did the shit work. Italians came over here, we did the shit work. The Germans were always engineers. So we'll see. I don't want to own a copper-based fund, but there are companies that I'm interested in to cherry pick. This is from a question. Is this down yet? Yeah, getting close to wanting to buy this one. You know the company that I prefer. There's a company in particular that I want. This is the rare earth metals ETF. It was overbought. It's coming down. Very top of the buy zone. I don't want it till it's down here in the 60s. I had a little starter position up here around 80, just in case. I mean, because this is a setup where it could have zoomed. I think you probably get one more pullback and make it look a little bit more wavy. And I think that as the EVs come on, this get way up here. I think it's a nice one to sell puts on probably. But this gap from here to here, right? That gap, it's going to get filled. They almost always get filled, right? So price down here in the 60 range. All right, let's call it a day. I think I'm babysitting. Not really sure. But I have to go lay down again because I will tell you, my ear is killing me. Be careful with your Q-tips. Have a good weekend.